It is an honor to have a CEO and a president of a mutual life insurance company here. Back in the day, a couple of years ago, interest rates were coming down, and there were some people that were like, is this going to blow up insurance companies? Let's talk about permanent life insurance.
Whether or not it's term insurance and protecting pure death benefit, right, and being able to do that and allowing other assets to do that. Permanent insurance, creating cash value, the ability to access that. You have this sort of uncorrelated asset or looser correlated asset. You also get the benefits of our risk management, our ability to manage that premium. Insurance is, we aggregate risks that no one individual could manage themselves. What all insurance does is it takes risks that are so hard to do, right? Things that don't happen every day, right? With life insurance, obviously, with providing death benefit protection, being able to provide cash in that product so that you can end up living the life you want.
We're gonna move on to talking about mutual insurance companies and investment philosophies and all. What do you say to the gurus out there that say insurance and annuity, like whole life, index universal life, and annuities are a total scam?
At the end of the day, risk creates volatility.
Yeah. What's your definition of risk? Hey Dave, welcome to the BetterWealth Show.
Thank you very much. It's great to be here, Caleb. Great to be with you.
It is an honor to have a CEO and a president of a mutual life insurance company here. And I have lots of questions for you. And it's weird because we have a niche on the internet of people that actually like this whole concept of insurance and annuities, and they have a lot of curiosity around it. So this will probably get more than one view on the internet. But before we jump in and I drill you on all things, what it's like to run a mutual insurance company, why don't you give your backstory? And because I think it's really inspiring. And I think that there's a lot of lessons that could just be learned from the lessons that you've learned growing up, now running one of the most successful, well-respected insurance companies out there.
Yeah, from my perspective, it is completely wild that I end up in the seat that I'm in and being able to be the CEO of a 177-plus-year-old mutual insurance company. But, for your viewers to not go too into it, because at the end of the day, it's been a really interesting career arc, and there's been a lot of interesting aspects of it along the way. I went to Drexel University, and one of the things that Drexel is known for is for its co-op program. So it's a 5-year program, and economics and finance was what I was going there for. And so for my first internship, I was doing that working for PNC Bank in their research operation that supported their money market funds, as they had owned BlackRock at that. Now I'm dating myself here with that. And my job as the intern was to photocopy the money market approval list. So I was really good at running the photocopier and getting out those paper jams. But one of the analysts there, and it was a really great culture that they had in that research group, ended up moving to the mutual fund arm of Penn Mutual at that time. So Independence Capital Management was the name of that subsidiary that we had. And when he went there, they needed somebody else who was really good at the photocopy, the stuff files. And he knew I was his person because he actually knew I grew up only about 5 miles down the road from where Penn Mutual's primary headquarters was.
Wow.
And so he made me a deal at 19 years old that you can't beat, which is he raised my pay from $7 an hour to $9 an hour. And at 19, 30 plus years ago now, you can't say no to that. And so I started at Penn Mutual in the investment area as an intern, spent the rest of my internships and my college experience working for Penn Mutual. And then when I graduated, I took a job being a investment analyst and taking over what really ended up being the commercial mortgage-backed securities area. And so my kind of background is in some of the more complex securitized structures and derivatives and those things. And over the course of the next chunk of years, I really ended up being responsible for each of the areas of the general account. And then
general account as in the general investment account that Penn Mutual has.
Yes. So basically, it's the commingled assets that that back our what I'll call our portfolio products, right? So obviously with variable annuities, they're in funds, but in fixed life insurance, fixed annuities, those are in the general account. And we manage that for the benefit of the policyholders and to make good on the product features that are in those products. And so industry lingo would be that's the general account of a insurer. And so from there, I had a lot of interesting opportunities, including getting into building out sort of the, today everybody knows them very much, the variable annuities with living benefits. So these are lifetime income features that are in all types of annuities. And so in the 2005 timeframe, was asked and tapped on the shoulder to build out a cross-functional team to develop not only the products, but also the hedging strategies that were behind that. And after we rolled that out, and that was really the first opportunity that I got to meet financial professionals, when we actually did that. And going out to our office in Akron, Ohio was the first time I actually ever went to a field office in 2005. And it was an incredible experience to kind of hear and see the products that, really at that point were just a bunch of formulas, were just kind of an academic exercise, truly come to life, and how that financial professionals position them to solve client needs. And then after that became our first chief risk officer of the company. So enterprise risk management was up and evolving at that point, and that's when I joined the management team. So it's hard to believe that 18 years ago I was joined the management team of the company. And kind of fast forward from there, the global financial crisis happened in 2008, and Penn Mutual, we did exceptionally well. Really, the programs that we had put in place to protect the organization, kind of the mutual philosophy we have to how we manage risk, paid off. And then I was asked to lead product development more broadly, ended up becoming our CFO of the firm, chief operating officer, and then president in 2016, and now CEO, and now chairman starting at the beginning of this year. So it's been a wild 30-year ride. I've just passed my 30-year anniversary with the company back here in March, and you would never have planned it, and you would never have planned all the things that happened along the way. But it just it's been a great experience, and I've had a chance to work with amazing people in the company and amazing financial professionals and field leaders across the organization. Yeah,
I feel like I could ask you lots of questions, but the two that I'm most curious about as it relates to your story is, number one, why insurance? I mean, you're 19 years old. You want to conquer the world, I imagine. Why did you choose to dedicate your life to one insurance company? That's number one. And then number two is, what are some of the lessons that you've learned in leading, growing? I'm sure you've had many failures and lessons that you've learned. And if you had to summarize just a couple, over the last 30 years, here are a couple things that I generalized of what I've learned by being in leadership, what would those be? It's
interesting, as you asked that question, I'm sitting here saying, I wonder if Caleb knows the fact that I actually did leave Penn Mutual, and I left that out of my career arc. And let's be perfectly honest. The truth was, the early 20-something-year-old version of me, I wanted to be on Wall Street.
Yeah, there you go.
That was my dream.
Yeah.
Right? That's what I wanted to be. And I think the other truth was, Wall Street didn't hire kids from Drexel. And so I had this amazing opportunity. I did some really interesting risk management transactions in what now feels like a million years ago, before a lot of the derivative rules that are in place today in derivative accounting, and caught the attention of Morgan Stanley with some things that we did coming out of, again, long-term capital management in the Asian financial crisis that happened in 1998, and got offered the opportunity to be in their fledgling credit derivatives effort in 2001. And so actually I left Penn Mutual for what is inside the company jokingly known as the repo trade, right? Because I stayed there for not very long. And that piece of the story, I think, gets to your question about kind of why Penn Mutual. But it was at the beginning of kind of where credit derivatives were out there. Had the opportunity to work on the first synthetic credit trade and developing that at my time with Morgan Stanley. And interestingly enough, all those products were part of what caused the global financial crisis right at the end of the day, right? Because it was that levered credit and CDO squared and things like that were really starting to be built. But you might say, well, why did you come back? Well, the opportunity presented itself because of things that were happening at that time. To go back into the history books, right? Enron had defaulted in that same time period, and the company was looking and approached me to come back to run really all of fixed income investing at that time. And I really realized, and this was kind of maybe my first sort of epiphany of the good that the insurance industry does, right? Because at that point, right in your 20s, it's sort of, you kind of have these dreams and aspirations, but maybe you don't know better. That we did something that was meaningful. We did something that had value and purpose. And I think at that point, I was also seeing not that making money and being able to do that, but that what we were doing in the credit derivative side, we were basically, it was financial alchemy. And that the products that we offered in the insurance industry do good for families. They support businesses. They do that protection. And so the opportunity and maybe even some enlightening of myself, my eyes open, that I wanted to be part of something more than just a financial transaction was kind of going on. And so I took the opportunity to come back. The company was gracious enough to have me back at that time. And so I did come back, and I kind of skipped that part, I guess, in the in our prior part. But that's a little bit of that history. And I think at the end of the day, why have I stayed? So right, that was 2001. And so 23 years ago, it's really been the people. It's been the impact. It's the size of the firm, the culture of the firm, that we have a real mission. We know why we're in business, the mutuality aspect, right? That we're policyholder is our beneficial owner of the firm, that we operated in the best purpose. All those things really resonated with me. But the platform itself and the people that I've had a chance to work with is really what has kept me there. We have great people. We have really, really good people that come to the firm. And it's been a privilege to not only work with them, but now lead them. And I hope that we continue to attract the right people and continue to build on that culture. And I found that very fun.
Yeah, when it comes to lessons, was one of the lessons just like realizing like why we work to begin with, like impact over, because it's like, again, there's that I can make potentially more money on Wall Street. When I first got into this business, I wanted to be a hedge fund manager. Mainly it was as shallow as I just looked at all the billionaires, and it seemed like a bunch of billionaires were hedge fund managers, and so I was like, that would be cool. And then again, similar to potentially you, I've realized that there's probably more to life than just making money.
Yeah, and being a capitalist, I'm a big time capitalist and all that, but I didn't out earn what I earned at Morgan Stanley until I actually joined the management team, and it did very well, but it was sort of like, it wasn't just all about the money. And there was a whole other experience that when I mentioned that I was out to that office in Akron, and there was a long time sort of consultant, had been a field leader, a financial professional, passed away at 93 years old, Maury Stewart, just a few years ago. And he spoke before me at that first agency meeting that I went to. And Maury wrote a book called The Miracle of Life Insurance. Wow. And he got up and he gave his talk about the miracle of life insurance. And I was sitting there in that room going, I am so not aware of what we do, of the impact we make. And also Maury was one of the great orators as well, and kind of going, I'm this nerdy kid. I am in big trouble getting in front of this big group of people, and Maury had been a great mentor to me. He provided me with great insights into the business, to being able to work with individuals and things like that. And so it kind of, as we all have our own career arcs, we all have those experiences. There's another one where somebody who was so impactful in not only in my life, but the number of people that he impacted over his 7 decades in the business was tremendous. And so you remember those moments, and you remember those relationships, and you try and pass those things on. Yeah.
If you were talking to yourself at 19, knowing what you know now, would there be any lessons that you would say, Dave, remember this, or this will save me a lot of heartache if I just,
I think at the end of the day, if I was to look back and sort of say, at the end of the day, all the accomplishments, you can look at all the quantitative accomplishments, the performance versus benchmark, those things. At the end of the day, the most rewarding things looking back, we're seeing how you worked with people, how you advanced their career, how you helped them achieve things that maybe they didn't think they could achieve. That would be so much more rewarding than what is so important right on the financial side, which is the numbers and being able to deliver results. Not that they're not important, but the truly rewarding things would be the impact on people and the impact on your colleagues and the people that you work with. That I didn't get in my early 20s, but appreciate so much today. Yeah,
what I love about you is you have a very strong investment understanding background, and that really has built the foundation. I think of, we're going to talk about insurance in a second. Like, if you're running an insurance company, you have to have people that understand what's going on. And so before we dive into some of my questions around interest rates and where your thoughts are for right now and the future of what it looks like to running a mutual insurance company, if you had to take a step back and say, let's give the big 30,000 foot picture of like, what is insurance? Why is it important from the insurance, like from your perspective? Because I've given time and time again of why it's important for people to have insurance and some of the reasons I like permanent life insurance and how it can be an amazing asset that can enhance other parts of your life. But if we had to take a step back, and if you had to explain to your family of like, the few minutes of like how insurance works, how would you articulate that?
I think if you think about insurance very broadly, insurance is, we aggregate risks that no one individual could manage themselves, right? So what all insurance does is it takes risks that are so hard to do, right? Things that don't happen every day, right? With life insurance, obviously, with providing death benefit protection, being able to provide cash in that product so that you can end up living the life you want, being able to live confidently. But those are risks that are extremely hard to manage as an individual. And so an insurance company aggregates all those risks, brings modern risk management techniques to price those risks so much more attractively than you could attempt to do that. And as a result, is able to deliver great value because none of us really know the future.
Right.
And insurance is all about protecting the future and protecting that from that uncertainty. Yeah. And so really then it's just the mathematics and all of what has to be there to make good on those promises and manage risks that are just very uncertain. Yeah. And so the insurance industry is tremendous risk managers. We manage that risk from, whether that's with life insurance, with mortality, with annuities, with longevity. If we manage that risk with, we have to buy assets, how do we manage credit risk? How do we look at interest rate risk? Because we don't know how long the products are going to be on the books, how many people are going to access loans at different times. Yeah. We become exceptional risk managers. And that's really what insurance does of all types. But I think that's what you see the mutual companies do the best, because at the end of the day, we look at that and say, we have to run the company to make good on the promises on our product and do so in a way that we're able to invest back into the business and invest back so those policies perform for our owners. The policyholder. And so to me, that is my simplest way to describe insurance. Yeah. We take risks that are out there. We manage risks, uncertainty risks that are out there. We provide the ability for people to live life confidently, to know that their loved ones, their business owners are taken care of in those events, and be able to make all the other products that you buy financial and you need financially work better.
Yeah. Yeah, we're gonna touch on that in a second, because again, I think there's a lot of different camps of people out there, and I'm under the camp of how do you enhance what you're currently doing, or how can you take other asset classes and make it better? And so I'm not a person that's like insurance is going to be the one thing that you need in your portfolio. Just like I'm sure you have multiple assets that you have to operate to make sure that you deliver on your promises.
Well, you've heard me talk, right? And one of my mantras around how do you manage the risks of an insurance company is that diversification has and always will be your best form of risk management. Yeah. And so, yes, insurance is an important asset. It's not the only asset. It's not the only thing you should have but it does make, because of the unique aspects of it, some of the uncorrelated features, if we get kind of into the mathematics of this, that allows other products to work even better and allows you to be more confident in the other decisions that you make, right? Because you have that insurance or that protection component well managed, you can do a lot more around savings and growth and investing and making other decisions in your life that product will really help you with. But diversification is always will be your best form of risk management.
Well, one thing that I admire about you is your humility. Like, you have a ton of humility. I'm sure that's what makes you an amazing leader. That's what people really adore about you. You understand investments. You also have a really good pulse on what's going on as a financial professional and what we deal with. Do you remember the first time you had the epiphany of like, oh, life insurance could be an amazing asset? There's a world, I heard you say this on stage once, that you're like, life insurance sometimes gets a bad rap, or insurance products get a bad rap from like the financial gurus out there. And like, what would you say? I know, again, you're not giving investment advice, you're just speaking from your point of view, but like, where do you see like these insurance products? Like, why do you think they're so important, and how do you think they can enhance someone's financial life? I kind of said that question's kind of a run-on sentence, but I'll just let you take it from there.
No, it's a great question. It's one that I get a lot, and I think it is because it is a unique asset in that it has a product that has a lot of different features to it, and it's not completely correlated to everything else that goes on. So there's different aspects of how the asset performs. If you think of it like a fixed income security, it's not marked to market that way. Right. So you can access your cash value on the basis of within that product, where if interest rates have risen or have fallen, it's not impacted by that. We manage that risk as the insurance company overall. And so I think that when I think of the asset class that way, it provides that benefit, whether or not it's term insurance and protecting pure death benefit, right? And being able to do that and allowing other assets to do that, permanent insurance, creating cash value, the ability to access that. You have this sort of uncorrelated asset or looser correlated asset. You also get the benefits of our risk management, our ability to manage that premium that you pay in, right? So the cost that you pay for the policy, the investment you make in the policy, we then manage those assets in places that maybe you're not able to access, whether or not it's in the fixed income world, whether or not it's in the private asset world, whether or not it's in the alternative asset space with venture capital, private equity, that are small portions of our balance sheet, but also make that asset perform very differently than a traditional bond. So
let's talk about permanent life insurance. There's concepts of like buy term and invest a difference. You guys have an amazing term product. I'm a fan of term insurance just in general, but we talk about permanent life insurance, and if you had to take a step back and talk about some of the pros and cons of why some people should consider it, and I know I'm putting you on the spot here, but like, what would you, from your positions, like, I'm sure you own permanent life insurance.
I do. Okay, I've owned a lot of different products, by the way, and so do my kids and my family, right? And we've used it for a lot of different purposes because, it does provide, it's a great, in a way, it's a great Swiss Army knife. It provides a lot of different solutions. Like for my kids, when they were really little, and my oldest is now off to college, we were using it as a 529 plan. Again, not making any investment advice for people. You have to look at what's right for your situation. But there's so many different things you can use the cash value build up or not use it for. Right? I've been very fortunate that way that, she'll be able to use that differently than what it was originally put in place, because we thought about it for school, but it's not going to be used that way. So maybe it's going to help her buy her first house, pay for the wedding. I don't know, right? And that's the beauty of it, is it's so flexible, but that store of cash is there. And then you have the different types of permanent insurance, right? Own index universal life, that is going to credit based on a cap and a floor around the S&P 500. Whole life insurance is more of a bundled product with strong guarantees in it, and own that for retirement income purposes. So have these products, they're out there. I think it's looking at sort of saying, what need do I have? What do I want to accomplish? And what's the best tool in the tool belt? Because I think one of the things that we're a bit unique in is that we offer a full portfolio of products. So I won't ever sit here and tell you, this is the best product. you have to look at what all the different products are out there and say, okay, well, what's right for your need? What's right for that situation, rather than saying this product works great. And term is a terrific product as well, where you don't have cash value,
Right.
but it gives you ability to convert.
Yeah.
It gives you the ability to provide temporary protection for maybe other certain needs, right? And I've used term for over the course of to protect if something was to happen to me for my family as income replacement, right?
Absolutely.
And so I think looking at the products for what they are and how they can do that, but that's why we position ourselves as a leader in life insurance. And we haven't just picked one product. We have as you know, a really diverse product portfolio, which is pretty unique in the industry.
One thing that I do, and lots of people that work and represent multiple insurance companies do, is they do what's called overfunding. They're max funding using paid up additions riders, maybe some term built-in riders, and get early cash and use it as an accumulation tool, but also as a protection tool. And it's interesting because when I look at that, and a lot of times you can get early cash early on, and it's an amazing product. But I look at it and go, how do these insurance companies make money? Because you're paying a staff, you're paying us, you're giving them lots of liquidity, and you're on the hook for current and future a pretty significant death benefit that increases. And I always go like, part of it, another question I have is like, people rag on life insurance being a bad investment and being the worst thing in the world. We could touch on that for a second, but I look at it and go like, how do you pull this off? It's shocking to me, like how this even works.
So obviously we are pooling a lot of risks, and there are charges in the product. Right?
Yep.
So those charges may sit there in cost of insurance charges for the amount of life insurance protection. We are an interest margin, pass that through, right? So there's different profit levers from our perspective. And I think that's where you start to see the institutional nature of us being able to invest in asset classes that are either harder to access, or bringing our expertise around risk management to do that, and being able to offer a compelling offering within the product itself. And so, different products, different funding patterns may be right for you, right? A lot of people do overfund the policies because you can put a lot of cash in a tax effective way into that product. And that's all part of the IRS tax code. We know the MEC rules, the modified endowment contract sort of tells you how much is the maximum you can put in, which tends to be the most efficient cash value structure. That type of analysis is so important to understand the need, understand how that works. But really, we manage all those levers. And we do pay large claims. I can remember just the other day, I have to approve any claims over $10 million, and the policy wasn't in force that long.
Wow.
But that's what we're here for.
Wow.
That's what we're supposed to do. And we would not have made money on that sale. We would not have made money on that situation, but that's what pooling of risk does. Because we're able to make that payment, we're able to do it quickly, we're able to provide that certainty. That's what the product does. And then there's other people who are going to live long past their life expectancy, but they're going to be able to access that cash value for that period of time. We're going to earn interest margin for longer. And so it really is, how do you think of all these risks, that all behavior isn't the same? And that's what we manage so well. And then we're able to drive that value back, because everybody has a different set of circumstances on when they're going to access, how they're looking at the product. And so what we're able to do is we're able to take that and pull that all together into what is really good offerings for consumers. And then also still be able to have enough money left over to continue to grow the company and invest in the company and technology. And that kind of is the virtuous cycle you're looking for with an insurer.
What do you say to the gurus out there that say insurance and annuity, like whole life, index universal life, and annuities are a total scam, a ripoff, and you'd be better off putting your money in the backyard than doing that?
Like, at the end of the day, I think that my belief is that that insurance makes all the other products work better. That when you take care of your protection pieces, when you take care of those things that matter most to you in your life, that only insurance can do as a financial product, that it's really not just a cost equation. It's a benefit equation. And you always should be looking at cost and benefit together. You shouldn't separate those two things. I think we know that there's a need for retirement guarantee income. Right?
Huge need.
We don't see that. I mean, when I started working, we still had a defined benefit pension plan. That was closed in 2005.
Yep.
Most people out there don't have guaranteed lifetime income.
Yep.
You can't really get that anywhere else than from an insurance company. And so those type of products, they have benefit. You have to decide what's right for you. Yes, there is a cost to provide guarantees. I will sit here and tell you that, you know, it's not a costless product.
Right.
But what's the benefit?
And that's the problem. A lot of people just look at the cost and they're not looking at the benefit. And a lot of people that, you know, downplay insurance or risk management products are looking on the front end and not looking on the back end. And I think if more people were educated by how retirement planning works, and I like to call it future cash flow planning, like they may decide to make different decisions if you have that framework of mind.
Yeah, and I completely agree, because it is that framework of mind. Insurance is not the asset class that you're looking for to have returns like your stock portfolio or an individual stock that's really doing. It is not. And no one ever should be told it's there for that. It is a really good, stable appreciation over time asset class that has costs in it, because there's benefits that accrue to either on the mortality side, from a death benefit protection, from a guaranteed minimum interest rate. Those things have costs. But that doesn't make them bad. That just means there's benefit to that. And does that work well in what you're trying to accomplish? And I think that cost benefit should always be the way that it's thought of. And everybody has to decide what's right for them. But there's no really other great place to be able to find these type of guarantees and benefits in other financial products that are out there. And so what's the right trade-off and what's the right balance of those things? It has to go to personal risk tolerance and situations, and everybody's situation's different. And that's why a trusted financial professional is so key, right? Is because, and you and I have had this conversation over time, it's sort of, you know, everybody has their own needs, and it really needs to be a custom tailored solution to their life, their outcomes, and what trade-offs are they willing to make, you know, today for goals that they have tomorrow.
You pass. We're gonna move on to talking about mutual insurance companies and investment philosophies and all. When it comes to just the whole concept of mutual versus stock, you touched on it briefly. I've heard you say, obviously you're biased, like you're running a company, right?
We are a mutual company, so I am biased.
But you have said, hey, listen, do the right thing for your client, and if we're not the right fit, pick another mutual insurance carrier. And so again, I don't want to put words in your mouth, but like, why is the mutual story so important? And the people watching, whether they work with me, whether they work with Penn Mutual, like why is the whole mutual conversation something that is important?
Yeah, I think it's really important to kind of go back and sort of say, what is mutuality, right? And at the end of the day, Penn Mutual and every other mutual insurance company, we were founded and we're beneficially owned by our policyholders, right? So those who have paid premiums into the company are the ones, right? We don't have a share, so you don't own a piece of the company, but we operate for the benefit of those policyholders. Think of it as kind of membership in another way, that way. So my job, right, as CEO of the company is to be fiduciarily responsible to the beneficial owners. Our board is there to oversee the governance of the company for the benefit of our policyholders. If you take that away and you start saying, okay, now I'm going to bring in a shareholder or other type of equity holder in one of these companies that, as we talked about, is managing these diverse set of risks that really do emerge over time. And to put to your viewers' perspective, our longest policy on the books on an annuity side was written in the 1930s.
Wow.
1930s. So you're looking at 91 years ago, this policy was written. And the annuity pays $25.34 and has since the 1960s. Right? So it was a deferred annuity. And it's been paying that. And our oldest life policy was written in 1935. So almost 90 years ago. And that's for a paid up $5,000 whole life policy that was written back that time. That's 9 decades. Think of what was going in the 1930s with the Great Depression and everything that's happened since then. Shareholders looking for a return. Their time step is not 9 decades.
That's right.
And so mutuality allows the company to take a longer term perspective it also says at the end of the day, we need to earn enough to keep the company viable, continue to invest in service, make good on the claims, continue to grow the company because that's in the best interest. But we're not trying to exact extra returns in order to satisfy an equity owner who wants a return, wants a return that's commensurate with other assets in the world. And so what we do, and I think that Penn Mutual really focuses on, is how do we run the company optimally, but we give back that money. Right? We run the company for the best interest. So you see that kind of invested back into the business, either in dividends or crediting strategies or taking less inherent risk, having less leverage. And I think you see this with rating agencies, and your viewers can look at this through other services with the credit worthiness of the industry. But that's where mutuality differs. It's who is the company, who's the management team, who are the day-to-day stakeholders, why are they operating the company in the way they are? And in the long-term promises business, I have said, and I continue to say, if you're a financial professional and a consumer, please look at the mutual companies. They may not be the cheapest, but again, it's back to cost, benefit, and being there for the long term. That's why, 177 years is a long time to be around.
Right. And so you say 177 years, but you said that your first life insurance policy was in the 1930s. What did you guys do before 1930?
Oh, well, this is the oldest one that's still active on the
Still
books.
active. Okay, that makes sense.
So, so we wrote policies all the way back into 1847. The company was founded that way by Quaker business owners in Philadelphia.
Got it.
For the benefit of them. It's interesting little side note for your viewers. The company was founded at the same time as the Pennsylvania Railroad.
Wow.
In Harrisburg, Pennsylvania, as a stock company.
Wow.
And so you've seen that, Penn Mutual continues to operate. And so, but we do that, and that we've offered insurance all the way through that.
Nice.
But those are the two longest still active policies that are on our books.
That's amazing.
You're servicing them 9 decades after they were put on. And that's the purpose. That's the point. Those guarantees and delivering on that for long periods of time.
And this is more of a statement, but if you want to share anything more, obviously you can't share names or super details. But like when I talk to people in our space and they have a death claim, or they have like an epiphany where like insurance or an annuity really came in clutch, like their conviction increases. I can't imagine for the insurance company, because you're seeing not just one scenario, but you're seeing all these scenarios over time. So it's just one of those things where every year goes by, just your conviction compounds because of just the more and more claims and stories that you guys get to see?
I think the more and more stories you hear, the more and more stories you see where lives are impacted positively. They continue to resonate. And then also you hear the stories where things didn't go as well. And that is the harsh contrast that's really tough when you hear sometimes how well things went, but then other times when people maybe didn't do the planning or passed on doing the things that they thought, or said, I'll do it later. And then it doesn't work out as well. And so we do get both. I mean, we do get both. We do have people, as you know, people in this business whose lives were impacted both positively and negatively because of experiences they had growing up, and either insurance being there to help them fulfill their dreams, or actually having to go through hardship because maybe it wasn't, and that planning wasn't done. And so those things are impactful, and over time you do pick up more and more of those stories. And you also hear about the people who live to 117 years old and, have lived these amazing lives over time. Overall. What
are some of the risks going forward when you look at the next 100 years? Obviously, you most likely won't be around 100 years from now. We'll see, but like when I think of longevity, when I think of interest rates, when I think of is the US dollar going to be around 100 years from now? And there's probably other things that potentially come up. Like, what are you thinking about? And like, what are some of the possible risks that not only are going to affect Penn Mutual, but could affect other mutual insurance companies?
I think the world's always evolving, right? The world is going to continue to evolve. Innovation is going to continue to happen. I do think that longevity is going to continue to be out there. Healthcare is going to continue to get better. People are going to live longer lives. Hopefully we live longer lives and more impactful lives, right? And quality of life continues. And I believe those things will happen. So I think you always have to look that innovation and progress will happen. I think you have to look that, we're going to continue to have to be able to evolve. one of the things about being around for a long time, right? The idea of computers, of AI, you go back 50 years ago, they were really just concepts. Now they're what we deal with and what we talk about. The fact that we can even have these conversations and how we distribute and communicate with all of our stakeholders is completely different than it was. And progress will happen. And I'm a big believer that you have to lean into that. You have to embrace that change is constant. That the fact that today is the least day of change in the rest of our lives, right? Change only accelerates. So you don't bet against innovation. You don't bet against progress. And you touched on the dollar. I also don't think you bet against America in the long term, right? At the end of the day, the dollar is still going to be there. The American dream, the American experiment is still relevant today. And, we're still being able to offer more quality of life than any country out there. And that's part of what we believe is a proud American company, is that those are the things that have been true to who we are. And are going to continue to be true to who we are as a company. Let's talk about interest rates, and this will be fun because you're a nerd when it comes to this. Okay, so totally.
Back in the day, a couple of years ago, interest rates were coming down, and there were some people that were like, "Is this going to blow up insurance companies?" So I'd love to hear your thoughts about that. But then now interest rates have spiked up, and so would love to hear your thoughts as it relates to future of how interest rates impact insurance, but then also. Even were you guys worried, or was it something that was, what was your thoughts around interest rates and how they impact?
So interest rates coming down, right? We've seen 40 years of interest rates going down over a long period of time, really since they peaked in the early 1980s. So when they got to that near zero level, there was definitely pressure on the industry. There was pressure on Penn Mutual. Why? Because there's embedded guarantees in our products that provided minimum floors for crediting. And we made good on all those promises. We made good on all those promises because we locked in interest rates over a long period of time. But it did pressure results. And that's, I think, a truism for all life insurance companies. And as rates have risen, that has been a tailwind. Now, it's not an overnight tailwind. Right, because we don't see that run through because we still are good disciplined risk managers. Means you don't ever bet it on a forecast. You don't ever bet it on rates are going to go this way or that way. But you're starting to see that kind of tailwind come through as you reinvest our assets at higher yields as they mature and new cash comes into the company at higher levels. And so, and you're seeing that start to flow through into products products for both in-force crediting as well as new product design continues to benefit from that. So just as interest rates being low and going lower towards zero was a headwind, interest rates rising is a tailwind for the industry and our products. But it really comes from because there are those guarantees in there. And so they cut kind of both ways.
Going back to the risk question, one of the interesting things about longevity and interest rates and all, like if you think about it, insurance companies have amazing balance risk because on one side you offer annuities, longevity, but on another side you have life insurance, which longevity ultimately I would be favorable for insurance companies. And so I think it's pretty interesting to see an insurance company have multiple products. And is that why you guys offer multiple products? Is it gives you guys a little bit options? It gives you options to be able to pivot?
100%. I mean, that's where that diversification, right? We're in the mortality business. We're in the longevity business. And there is an offset to that. There's a natural hedge. And we price those products, again, back to that they're attractive on a standalone, but you start to put these pieces together and they even work even better. And those risks, we manage them out, we diversify them over a large base of policyholders. And so we're able to have that kind of positive impact that way. And so, we are on kind of both sides of it, offering solutions. And that's why I go back to it's the solution that the client needs. What are they trying to accomplish? And then what's the right tool for that? And what's the right tool to have that done? And then so for us, we can actually naturally hedge ourselves, right? And that's something that is really tough to do as an individual, or even as a corporation. Looking at how do I actually create self-hedging because you need those diversification benefits of scale.
So I'm going to throw a curveball at you, and I'm curious to hear how you're going to handle this. So you most likely own individual stocks in your personal portfolio, I'm assuming. When it comes to the insurance company, you guys have, promises that you deliver on, and I imagine that majority of the portfolio is not equities. So what is your thoughts around that, and why is there something that consumers can learn about how insurance companies manage for the future? And is that something that we should model, or is it one of those things where it's like, let's just buy an insurance product, and then I guess I'm looking for Dave O'Malley's framework of how he thinks about money, and if there's lessons that we can learn as an individual about, not just do what they say, but do what they do.
Yeah, so I think that, I do own equity securities. Actually, I own mostly funds and ETFs and things of that nature. You can imagine in my role with the fact that we have 4 insurance companies, 2 broker-dealers, 3 RIAs, a 40 Act fund complex, that there's quite a bit of requirements on in terms of the reporting of transactions. Yeah. And so, the more generic those things are, the better off they work, because there is a lot of reporting and appropriate reporting for that type of. But I think first you have to look at, where's your risk tolerance? What are you trying to accomplish with your money? Is that money short-term money? Is it long-term money? What is the horizon? What's it there for? Is it for retirement income? Obviously, you can take more risk and have a longer term horizon. You probably have a riskier portfolio. As you get closer to retirement, maybe you need income, that portfolio changes. Well, we do similar things on the insurance company side, but because we're liability driven investors. So, right, we sell all these products, and we sell these products to consumers, as we've talked about, that do different things. And then we take those products and say, how are we going to buy assets against them that meet the sort of expectations of that? And then how do then all those come together so that we can bring them together into that overall portfolio construct? So our balance sheet, right, most simply defined for your listeners, is that we're about 85% fixed income. As we sit here now, about 97% of that's investment grade, 3% is below investment grade. So a very high quality book of fixed income. It's broadly diversified amongst corporate bonds, which represent around half of that fixed income component. And then different structured securities, be it residential mortgages, different types of asset-backed securities, commercial real estate type of loans that we buy in packaged form, treasuries, cash alternatives, those type of things make up that fixed income portfolio. And then you say, what's the remaining 15%? We have about 5% of the portfolio that I'll call is very much driven for liquidity and hedging, right? Because we utilize derivatives to manage interest rate risk, yield curve risk, other types of things, and we have to put up collateral for that. So we have about 5% that's derivatives and collateral. We have another 5% that we view as more of our long-term growth investing, which is in what we call our alternative asset portfolio. That's broken up about 50% roughly in venture capital, A, B round mostly. And then the other 50% is in private equity. We tend to focus on small, mid buyout type funds. We do some credit funds. We do some things on the real asset side. So very diversified, but provides a little bit of upside to the portfolio because those assets are really sticky and liabilities are really sticky and long term. So we can buy some less liquid assets with that 5% sleeve. And the other 5% are our affiliated companies, which provide, whether or not that's asset management and where we earn fees on managing other people's assets, and then also in broker dealers and wealth management platforms where we earn money from having those assets on platform. And so those results come back in overall. But I always think when you look at it, you have to come up with a long-term strategy as an investor and then make it goal-oriented, because part of that goal is how much risk and what are you trying to do with money. For us, the liabilities drive how we invest. And that's how we think about it. I think for individuals, and when I think about my own, what am I trying to accomplish? What's my time horizon? And what do I want it to look like when I get there? What's my savings rate? What am I looking to accomplish in retirement? All those things.
What I love what you said is, okay, so you guys have certain liabilities, you invest for a purpose, and there's intention about where your money's going. And I think individuals, like, if you don't know where you want to go, then that's problem number one. Get really clear on that, but then look at assets as a way to fulfill on the promise or the desire of your life. And I think it's like, if it instead of us removing responsibility of saying like, oh, I'm just going to defer to somebody to tell me what to do. It's like, no, like you have assets that should hopefully be able to fulfill and really take ownership of that. And I think, again, a lot of times investing becomes scary, but if you simplify it, it shouldn't be, and it should be something that regardless of who you are, you should embrace and take responsibility of your life.
I think, to your point, if you think of the outcomes you want to be, you want to accomplish as an individual or as a business, right? For us, it's making good on the promises we have in our products. For individuals, it's right. What do I want to accomplish in retirement? What do I want for money at this point? Do I want to open up my own business? Whatever it is, and then start with the outcome and work backward to what are the tools in my toolkit that make that happen. I think it's a much better than saying, here's all these tools in this broadly diversified financial world. I think this one's going to beat all these others. I think it's a lot more easy to look at what's the right answer for you, because it's always going to be the right answer for you or the institution if you look at it the other direction.
When it comes to PE, if those all went to zero, would you guys still be, are those like just giving you like home run? Because I imagine they're either going to hit home runs or go to zero, but like that's why the majority of your fund is like fixed income and all. But like the PE, I bet that's a world that was, especially with the massive balance sheets that insurance companies are, like that might be small, but it's still, I mean, I'm sure you guys are able to write some pretty exciting checks to.
I mean, it's an interesting area, right? Having been involved in the investment side for a long time, because it's broadly diversified. It provides pretty good returns.
Oh, nice.
And we get some advantages over the public markets in aggregate over the long term.
I bet.
Right. But you can't.
You guys are getting deals that I'm not getting. Let's just
no,
put it
and
that
I'm
way.
not getting either. To be perfectly honest, that institutions have to be able, and there is providing access to that. And we have an entire team that is out there building relationships in that world and talking about why a good partner would be Penn Mutual. Why should you take our money in that space? Because the difference between the top performers and the bottom performers is so great. And so sorting through that, but we don't make big positions there because you don't know which ones are going to be the best ones and which ones may go to zero. But what we have, it is broadly diversified enough that we see good, solid returns over time. Doesn't mean it doesn't have volatility. Right? It has volatility, but we have enough financial wherewithal to absorb that volatility and take the upside over time. And that adds incremental value. So I like to think of it as, because our policies are around for so long, we have the ability to take some amount of illiquidity risk. Right.
I like that.
And so this is a piece of the portfolio that benefits greatly from our ability not to need to access money. Right? We're very operationally positive on a cash flow basis, which means more money is coming into the organization. So some of our assets don't have to be throwing off returns or consistent returns like a coupon on a bond.
Right.
And so we can take advantage of that and then put that into the equation of creating value for policyholders and the features or the performance of their cash value.
It's interesting because what you do on a massive scale is if you bring it down to the consumer, a volatility buffer. One of the reasons why permanent life insurance or an annuity or even like a reverse mortgage could come in handy is it creates volatility buffer and potentially allows other assets to be able to recover. And also from an investor standpoint, if you're able to not need the money, you could potentially have more of a long-term mindset. But if you need that money, you can't say yes to potential opportunities that may get a better return over time, but it would be irresponsible if you're holding nest eggs in something that has that volatility.
Absolutely. And so how do you think about managing volatility, right? And I'd probably use the word risk more in the conversation we've had today, but you can almost use them analogous, right? At the end of the day, risk creates volatility.
What's your definition of risk?
So risk can be broadly an outcome that's other than the one that you expect, right?
I like that.
So, right, is I expect this is going to do X or return X, but it returned X plus or X minus. That difference is risk. That's risk and expected outcome, right? Risk might be that you expect that my life expectancy will be somewhere in the 85 to 90 year range. I could pass away sooner than that. I could live much longer than that. That's risk. Volatility from the expected is risk. How do we manage to that? Assets have that. We don't know where I don't know where the market's going tomorrow.
Yep.
I don't know where it's going over the next year.
Yep.
How do I want to manage the difference between that, right? We know that there's broader economic things around inflation, growth, expected real asset performance that you can build and say, well, this is what I think the long term is. The truth is, it's going to be different than that. That's the one certainty, is it's not going to go in a straight line. It's not going to be that. And so that's the risk. And how do you manage that risk? What assets buffer risk? What assets provide a buffer to it and bring stability? And what assets give you the upside to be able to do that? And some of those things are liquidity. Some of them are different things like credit risk, equity performance, right? And how do you build that? But I always think you have to look at the risks that are out there, and that's the differences from expected. And then how do you build either your personal finances with a long-term perspective to deal with?
I want to talk about alternative assets, but like, is there a reason you guys don't invest in ETFs or indexes as a company? And the reason I think why is like, there's less upside. It's like you're taking on the volatility, but if you put your money in the S&P 500, let's just say like the upside versus in PE, like I guess maybe you do, but like why doesn't Penn Mutual put most of their portfolio in an index?
Well, at the end of the day, the reason we don't put it in an index is you think of the liabilities rate rather than it's all in the life insurance, as you would say. It looks more bond-like than equity-like. So if you start with the liability, you're paying a consistent return or consistent dividend to policyholders, right? It changes, but consistent being that there's expected to be an annual credit. There's going to be a quarterly credit to that policy. That's going to be best managed, that risk, by fixed income.
Got it.
But then it's not going to leave tomorrow. It's not that only piece. So you can get some additional upside because you're not managing that cash flow. Now, we do manage and hold things. We actually own insurance in the insurance company. Insurer-owned life insurance.
Interesting.
And it manages other risks for things like our deferred compensation programs and for different benefits that we offer to our employees. And in there, you see we own index funds and things of that nature, because that's actually the best place for that.
Got it.
And that asset. Why does alternative assets fit? Because actually it has less mark-to-market volatility because of the broad diversification. So it actually goes through our financials. And if you think about our financials, right, it's the assets we have as a company minus the liabilities is our surplus. That's what's there to pay claims. If those assets are really volatile, then that flows through to your surplus being volatile. We don't want our claims paying to be volatile.
I understand.
We can accept some volatility to that. But so the fact that alternative assets have a different mark-to-market profile than the public markets actually is advantageous. And that's why you see that handling there. When we have other liabilities, whether or not it's employee benefits or things like that, you may see us invest that more in some of those index strategies. So it's not that we have an issue with index or we're against that, because I own them myself. It's that the right tool in the right place for the right reasons.
All right. So we're going to do a fire round. I'm going to ask you just a bunch of questions.
Okay, fire round. This will be interesting.
So dividend, what goes into you guys deciding on a dividend? And it's so interesting because every insurance company, a lot of insurance companies that we represent, have dividends that they publish. What's frustrating to me is it's like they all mean something different. Doesn't mean that they all will perform the same. But how do you decide what the dividend is going to be? And then what is your philosophy as it relates to the stated dividend?
Yeah, and there's a lot to this that I'm sure you've gone into around the difference between a dividend rate and what the cash value of a product. And they're not the same thing.
Yes.
And
some people say they are, and it should be malpractice for them to, but
they are not the same thing. You should always, in my opinion, you should look at what's the cash value IRR.
Yes, agreed.
And understand that the dividend credit rate is one of three components of the dividend, right? So there's the dividends are made up of three things: interest, mortality, and expense. And I think every company should be able to talk about those components. Interest is pretty straightforward. It's we earn money on those bonds that we've talked about in this conversation. What are we earning on them? What's the margin we need for profit? How do we pass that through? What's the portfolio rate? This isn't just the bond we bought yesterday, but we've been buying them for a long period of time. And how's that portfolio performing? And so it moves up and down more slowly over time as that rate changes. Then you have mortality. Is mortality performing as or better than expected? We expect that our mortality pricing over the long term is going to be really solid, and that adds to the dividend and back into that. And then expenses. Are we running the company efficiently? How are we operating? You mentioned like salaries, computers, real estate, right? All those other things that go into it. That's another component of the dividend. You pull those all together, and that becomes kind of how a whole life policy performs. So the way we think about it is, what is the rate that we can offer to our policyholders based on all of our assets, the company's mortality performance, our expense management, that we can maintain and sustain based on our current balance sheet for, we prefer to have a consistent dividend story, which means we really want to only change the dividend up or down once every couple years and be able to really try and hold that dividend at that level for that period of time. Obviously, we don't know where the future is. We've touched on that. But that's where we see the world going, because we don't want the dividend going up and down with volatility. We're going to be able to have a more of a consistent dividend approach. So it's really three components. It's that interest component, mortality, and expense all goes into what a dividend calculation is.
Well, and I just want to congratulate you, because over the last 10 plus years, and I can only speak from my experience, ever since I got into the space, Penn has always been respected. And over time, as other companies have maybe created a little bit more volatility in their dividend rate, Penn has really shown there. And so that just goes back to the consistency and also the performance of the contracts perform well. And so,
I mean, it is a reflection of the performance of the company, the performance of its assets, the performance of its more underwriting, its performance of its expense management. And I do think that what we've tried to do is be able to pass that back through in a consistent dividend, and it's something that we're very proud of as it goes back to benefit our policyholders.
If you're an accredited investor watching this and you're like, I'm curious to hear Dave's thoughts on alternative assets, you're not giving investment advice, but is there any asset that you'd be like, you should do more research on this? I remember a couple of years ago, allegedly Mass Mutual, put money into a Bitcoin, like a large dollar amount when you look at a consumer, and that got people kind of buzzing. But is there anything that you're like looking at from a standpoint of like, oh, this is what we're seeing that maybe the listener or watcher should do some more research on?
Well, I think I'm going to stay away from crypto and everything else, from that perspective, and not really opine on that. I think there are a lot of investment tools out there. I think that do your own research. At the end of the day, that's my, if you really have an interest in this space, do your own research, really dig in, see if this is the right fit for you. The true long-term performance in financial assets comes, I think, from really understanding what's underneath it, what's the best expectation, and doing that homework. We spend our time there. I don't think there's one magic asset class. There's always things that are evolving. I can say that we don't own crypto.
Okay.
And the reason, and I'm not going to make a judgment to anybody else, the reason we don't is, when you think about what our liabilities are driven in, they're denominated in dollars. That at the end of the day, that's where we have to deliver. We have to deliver those dollars back. And so to me, it's very uncorrelated. May not be a bad thing. But we've chosen to sort of, stay with dollar denominated, right? Just like we don't invest in a lot of foreign currencies, right? We're a U.S. company where we write our policies are written in dollars. So you're not seeing us go out and do big investments in euros or yen or some other foreign currency, because it's not tied to what we do.
Understood. When we talk about size mattering, and one of the things that Penn Mutual is a well-run company, but they're not as big as some of these, what some people call mother mutuals. What would you say to that? And I'll kind of ask another question. When I talk to people about how we choose different insurance companies, it's like the mutual conversation is a must. The ratings, making sure that these companies are financially strong and the ratings are good. And then also, do these companies, can they give us the products that can enhance? Because you could have a really solid company, but they might not have the contracts that, could be designed in such a way to actually enhance. And so Penn Mutual, like a lot of other carriers, check those 3 boxes. What would you say to someone who says, well, size, like I just want to go with the biggest company, and what are the pros and cons of that?
Yeah, so I think that at the end of the day, right, there is some efficiencies that come from scale. Right,
Yep.
That's just a truism, right? Whether or not it's spreading fixed expenses over a larger base, and then there's advantages to being nimble
Yep.
and being able to take advantage of opportunities in the marketplace and being able to do that. And those are trade-offs, and that's where companies differentiate. So
Yep.
I think you have to decide what's better and which one you look at. At the end of the day, financial strength and the ability to make good on the claims here really does come
Yep.
down to that surplus that we talked about earlier, right?
Yep.
Well, how much money do you have
Yep.
to make good on the promises that are there? That really is something that doesn't matter as much by size. It really is, I have this many things that
Yep.
I have to pay on. This is where it is. And you see the rating agencies do that through their kind of claims paying view.
Yep.
And I think you see the mutuals have extremely strong balance sheets, partly because we're able to hold that extra capital.
Yep.
Because we're not under the pressure to get the highest return on capital for shareholders.
Yep.
So I think you have to look down at ratings, but we are able to be very nimble.
Yep.
I think what we really focus on is making sure that we have exceptional products and services that meet the needs of consumers.
Yep.
We want to make sure that it's easy to do business with us. We've invested a lot in technology
Yes, you
and
have.
tools that
Yep.
make it easier to acquire our products, provide an exceptional customer experience. But at the end of the day, we have to also have tremendous financial strength. So
Yep.
I like to think about those 3 things.
Got it.
Products, ease of doing business, financial strength. We need to be focused on doing the best we can around each of those every
Yep.
day. And I do think the fact that we are not the largest company allows us to be very nimble.
Yep.
And you can see that in our technology. We're 100% virtualized in the cloud company,
Yeah.
which is very unique in the in the insurance industry.
Yep.
We have really good tools for our customers. With
You're
our
leading the way
apps.
when it comes to underwriting, and like you don't necessarily have to get poked. Every single client doesn't have to go through the maybe typical route. Obviously, there's exceptions to that, but it's like that's amazing. You guys save so much money in just embracing technology as it relates to that.
Yeah, and even think about the paper applications and not having incorrect applications, or
Right.
having a consumer fill something out and finding out there's a new variant to that
Yeah.
application that's out there. Being able to have a digitized buying experience, and then underwriting is just kind of I'd say the additional area to that. And so for us, those are the areas. But I don't always think that big has its advantages,
Yep.
but being nimble has its advantages too. And then it comes down to execution
Yep.
and being able to deliver. And I do think you have to look at financial strength as sort of
Yep.
something of that is something that is proportional to the exposure you have.
Yeah. Well, and you had a great answer the other day when you talked about the difference between a Ferrari and one of these bigger. And you guys, what I love about Penn Mutual is like you're laser focused on what you're doing, and you're not. The goal is maybe not to be the largest. Like that's not necessarily your goal. It's to have excellent service and products to the people that you serve.
Well, yeah, I think our strategy, and I think this has been refined over a long period of time that I've been with the company, right, is that we are unwavering in our commitment to mutuality, which we touched on. Mm-hmm. We look to have great relationships with financial professionals, right? Because we realize that the best advice is going to be given by a financial professional to determine what's in the best interest of your client. What's the right product? What's the right company? What's the right value proposition? That way. So we want to make sure we develop those relationships. We want to be a leader in life insurance. So you see us have that broad portfolio, and we want to make sure that we have exceptional service to do that. And that is really what we work on each and every day is getting better in sort of who we are in that value proposition. We're not trying to be everything to everybody. And I think we continue to evolve and continue to grow and continue to add good value where we've chosen to compete.
Dave, if you could snap your finger and like pass on one thing to the financial professionals out there, and like if you could download like this one concept or like this one mindset that you have, would there be like, what would that be? If you were like all the people representing and helping people when it comes to money, what would be like the one thing that you would pass on to them if you had that ability?
I think it's to see more people. I mean, I really do. I think that the financial marketplace, right? There continues to be incredible innovation, proliferation of products, not just in the insurance space, but all across financial products. And I think that the more financial professionals can get out, see more people, help them utilize the tools, technology, techniques to be able to communicate, connect, and deliver value. I think that's the thing. Because you've heard me say this, right? What you do today as financial professionals is more needed and more valued than ever. And I view that uncertainty has done that, right? We're coming off a once in 100-year pandemic. Who saw that coming? We haven't seen inflation right during my entire working career. Right. My entire career, we haven't really seen an inflationary period out there. That creates uncertainty. It's a different environment than a disinflationary. All those things impact people's financial lives, the expectations that they have. And that's why I think that, the opportunity to see more and connect with more people, that would be my message to financial. What you do is valuable. What you do is impactful. And to, please keep getting out there and connecting with people and being able to help them live their dreams and aspirations.
Dave, is there anything else you want to share?
No, this was great. It was great spending time with you, Caleb. And let me also congratulate you as a top financial professional and somebody who has impacted many lives, leading the company last year in the number of lives and individuals that you've written business on with the company. A tremendous outcome. So it's been great being with you today.
It's been great being with you. I appreciate, again, your humility. You're down to earth. You have a pulse on investing. You have a pulse on financial professionals. You have a pulse on products. And it's fun to see where the future holds. Got one last question that has nothing to do with insurance or investments. It's the question I end all of my shows with, and it's the legacy question. If this was your last day on earth and you were with the people that you love the most and you couldn't give them any book, video, or anything, you just had a conversation, what would you touch on in that conversation?
I think it would be to live life to the fullest, make your life significant and impactful, and touch other people. Because that's what you'll remember, I think, at the very end is who impacted you and who did you impact along the journey.
Dave, thank you so much for taking time to be on the show.
No, thanks, Caleb. Great being with you.
Hey, it's Caleb Guilliams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this and asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the and asset, different setups and designs that we use. And then we have an and asset vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.